Assalamualaikum to Madam Hairida and also my friend. My name is Muaz Aish bin Norikuan. My number matrix number 06D8023F1028.
Hello and Assalamualaikum to Madam Hairida and also my friend. My name is Muhammad Iskandar bin Muhammad Zulkarnain and my matrix number is 06D8023F1059.
Assalamualaikum and hi. My name is Emisha Diana binti Muhammad Hairi. My matric numbers is 06D8023F1121.
Hello and Assalamualaikum. My name is Khairuniza Sofia binti Khairuddin. My number matric is 06D8023F1016.
Hello, Assalamualaikum. My name is Nur Alia Mashanna binti Nuruddin. My matrix number is 06D8023F1143.
First of all, the important things we need to know is the nature of equities. What is equity? The accounting standard related to equities shareholders is comprised of all capital contribute to the entity plus retained earnings. International Accounting Standard (IAS) suggests that shareholders' interest be subcategory into three broad subdivisions, which is the first one is issued share capital, retained earnings, and other component of equity. Equity is the net amount of fund invested in a business by its owners plus any retained earnings.
I want to present about types of equity. There are 6 types of equity. The first is common stock, the share that entitle the share owner to vote and their residual claim on the company's asset. The second one is preference stock, a type of share that often has no voting right but is granted a cumulative dividend. The third is retained earning, the portion of net income that is not paid out as dividend to shareholder. It is instead retained for investing in the business or to pay off future obligation. Next, contributed surplus, any amount paid over the par value paid by investor for stock purchase that have a par value. Other than that, treasury stock, a contra equity account. It represents the amount of common stock that the company has purchased back from investor. Last, other comprehensive income, represent the amount excluded from net income on the income statement because it consists of income that has not been realized yet.
Today I will be present about the equity cycle. Firstly, identify and analyze the transaction. Second, record to the journal entries. Third, post to the general ledger. Fourth, prepare an adjusted trial balance. Fifth, adjusting entries. Sixth, prepare adjusted trial balance. 7. Prepare financial statement. And last but not least, closing entry.
Now, let's see the source document that we use for equity. The first one is share certificate. Share certificate is an official document issued by a company to its shareholder as proof of ownership of a specific number of shares. The second one is allotment letter. Allotment letter is a formal document from a seller, developer, or financial institution confirming that a specific property, loan, or other asset has been allocated to a buyer or applicant. The third one is prospectus. Prospectus is a written document used in finance to inform the public of the relevant details about an offering of securities such as stock, bonds, and mutual funds. The fourth one is memorandum and article of association. It's refer to the company's structure and aims. These are the fundamental conditions upon which the company is incorporated. The last source document for equity is share application form. Share application form is an order to buy new shares in a company when they are made available for sale.
Now, I want to present about the audit assertion. First, occurrence. The transaction and events that have been recorded or disclosed have occurred, and such transactions and events are pertinent to the entity. For example, recorded capital stock transactions occurred and are accurately recorded. Second, the accuracy. Amounts and other data relating to the recorded transaction and events have been recorded appropriately, and related disclosure have been appropriately measured and described. For example, verify that stock and dividend transactions have been properly posted and summarized in the accounting records. Third, existence. Item and amounts recorded in the financial statement really exist as of the reporting date. For example, share capital reported on the balance sheet really exists at the reporting date. Next, completeness. All transactions and events that have been recorded and all related disclosure have been included in the financial statement. For example, all share capital transactions that should have been recorded have been recorded. Next, valuation. All items in the financial statement are recorded at their correct and fair value in accordance with the applicable accounting standard. For example, share capital balances are valued in accordance with applicable accounting standards. And last but not least, presentation and disclosure. All related disclosure are relevant and understandable in the context of the requirement of the applicable financial reporting framework. For example, sufficient information about share capital have been properly disclosed in accordance with applicable accounting standards. That's all from me. Thank you.
The first is recording transactions. The primary step is documenting all financial transactions. Transactions may include sales, purchase, expenses, loans, and investment. Equity transactions such as issuing shares, paying dividend, or share buybacks must be recorded. The second one is classifying transactions. Transactions are classified into appropriate categories based on their nature. Proper classification is needed to determine the accurate financial position of the business. Equity transactions are categorized under share capital, retained earnings, reserve, or treasury shares. The last one is summarizing transactions. Summarize the transactions into financial statement to provide a clear overview of the business financial health to the shareholder. Equity balance are summarized in the balance sheets and statement of changes in equity. Next one is analyzing financial data. Analyzing the financial reports is a crucial aspect of accounting process. Business owners assess the financial data to make informed decisions, identify errors and areas for improvement, and plan for the future. Analysis of equity helps evaluate profitability, dividend capacity, and shareholder value. The last one is financial reporting. The financial reports are distributed to stakeholders such as investors, creditors, lenders, and regulatory authorities. Stakeholders can assess a business stability, profitability, and prospect through this. Equity reporting informs shareholders about capital raise, dividend policies, and reserve. That's all for me.
Today I will continue the presentation about control activities which is related and equity. The first one, authorization and approval of transaction. All equity related transactions must be properly authorized. For example, before issuing new share or declare dividend, the decision must be approved by the board of directors or top management. This prevents unauthorized transaction and ensures that equity activities are aligned with the company's strategy and also the financial goals. The second one, segregation of duties. No single individual should have full control over equity transaction. The task of authorized recording and monitoring must be separate. For instance, one person authorizes the issuance of share, another records it in the financial book, and a different person monitors the compliance. This separation reduces the risk of fraud, manipulation, and also human error. Furthermore, accurate and complete record keeping. Equity records such as shareholders' equity, capital stock, reserve, and return earnings must be maintained. This ensures that the company has up-to-date information about ownership structure and also profit distribution. Poor record keeping could lead to dispute with shareholders or misstatement in financial statement. The next one, reconciliation and monitoring. Equity account must be regularly recognized with financial statement and also supporting documentation. For example, the balance of return earning in the ledger should match the figure in the statement of financial position. Continuous monitoring helps detect discrepancies earlier and maintains the accuracy of financial reporting. Next one, proper classification. Equity transaction must be correctly classified in the financial statement. Issuance of shares should be recorded under share capital, dividends under return earning, and reserve in their respective accounts. Proper classification ensures transparency and helps stakeholders understand the true position of the company's equity. The last one, compliance with legal and regulatory requirements. Finally, all equity activity must comply with laws and accounting standards such as IFRS or GAAP. This includes following the correct procedures for issuing share, respecting debt covenants, and providing accurate disclosure in annual report. Non-compliance may result in penalty, loss of investor confidence, and also legal action. That's all from me. Thank you.
Now, I want to present about audit procedure. Transaction-related audit objective. Ensure and confirm of equity. For test of control, obtaining a schedule of all activity in the account for the current period. The beginning balance is agreed to the prior year's working paper and the ending balance is agreed to general ledger. Next, substantive test of transaction. Test of occurrence of capital stock transaction recorded in the current year to the board of director minutes. Transaction-related audit objective. All equity was included all transaction for the reporting period. For test of control, examine supporting document and authorization for all transaction in the account and considering conformity with GAAP. Next, substantive test of transaction. Check the share outstanding in the stock register and or stock certificate book and agree them to total share outstanding in the general ledger.